It certainly was an outstanding third quarter for all three local banks, as they posted record profits on the back of higher net interest income. Singapore's largest bank, DBS, led the way, with a net profit of 2.24 billion Sing dollars, up 32% from a year ago. OCBC was next, with a net profit of 1.6 billion, up 31% from last year, while UOB recorded a $1.4 billion net profit, up 34% year on year. The banks largely benefited from the aggressive rate hikes undertaken by the US Federal Reserve this year in a bid to combat rising inflation in the United States. This improved the bank's net interest margins, or NIM.
That's the amount of money that a bank is earning in interest on loans compared to the amount it's paying in interest on deposits.
Going into next year, we do still expect more NIM expansion to come, but of course with the funding costs catching up to the higher asset yields, we do think that the NIM expansion that should still go up. We expect this to narrow quarter on quarter. So you will see higher margins, although the expansion will be at a lower rate. Beyond that, we're thinking that the growth outlook that should slow going to next year, especially with the rates going up to these levels. We watch out for higher credit costs to come, whether it's from the retail portfolio or the SME portfolio.
This cautionary tone was echoed by the senior management at the three local banks. Concerns raised include slowing growth and especially the risks of a recession in the United States and a consequent sharper slowdown in Asia if rates keep rising.
No bank anywhere in the world is recession-proof. So if there's a recession in the United States or more profound recession in Europe, that will certainly affect the market sentiment, that will affect this part of the world. This will affect negatively Singapore, right? The other major thing is China, right? China's economic growth has been slowing. China has a problem with the real estate market for quite some time. And the three Singaporean banks have large exposures, direct and indirect, to China, Greater China, including Hong Kong. So we'll be looking as well how China reopens. If it reopens massively, what does it mean for the markets? Can China again push the economic performance in this part of the world a bit higher or not?
So with all this uncertainty, should investors stay invested with the local banks? Maybank Kim Eng says yes and has a buy call on all three banks.
All three have very strong capital levels as well as provisioning levels. So this will enable them to pay significantly higher dividends going forward. Particularly, looking into fourth quarter, we think that the dividend side should actually come in quite strongly. Our top pick is DBS. They've got one of the lowest funding costs amongst their peers, as well as one of the strongest franchises out there, and we look at ROEs hitting around 15% for them going into next year. So I think that will justify a higher valuation. At the same time, we also like UOB, given their ASEAN sort of presence. And I think amongst all the regions, given the sort of large domestic consumption basis that ASEAN has, that will provide some recession proof versus some of the other more developed markets, and I think UOB will benefit from that as well.
Another area that remains positive for the banks is how their non-performing loans, or NPLs, have been faring.
This time around, the NPLs went down, so this is a positive development. So I think the banks have started the year with about 1.5% problem loans ratio, then came down to about 1.3, 1.4 right now. So a bit of decrease, a bit of improvement. And that's a positive sign. Again, we expect that NPL will probably go up slightly next year. Again, nothing too dramatic. They will stay below 2%. And the good thing is that the banks in Singapore have really good buffers. They have good reserves already, and they have good capital to protect themselves against those risks.
And even in a scenario where the US goes into recession, experts point out that banks here in Singapore have learnt many lessons since the last major recession in 2008.
If you look at 2008, which was a financial crisis, and we also saw a significant amount of regulatory and capital requirements being put on the banking sector since then, which has allowed them to get to a position where you have today, where provisioning levels are high, capital levels are high, the loan books are a lot more diversified, the type of businesses that they are in are also a lot more diversified. So, it's very hard to draw a parallel to 2008 for the banking sector today.
CGS CIMB also maintains a positive view on the local banks and has ad calls on all of them.
DBS is currently trading at 1.3 times price to book. The other two banks, OCBC, UOB, they are trading at about 1 time price to book. Over the previous rate hike cycle, and at the time, DBS was trading at about 1.6, 1.7 times. So at 1.3 times, with the expectation of the Fed still hiking their rates, there is still some more space for DBS to run. For OCBC, UOB, during the previous rate hike cycle, both of them traded to 1.3, 1.4 times price to book. So coming from the 1 time price to book now, there also seems to have to be more space for re-rating going forward.